Welcome to StokTok's deep dive into International Business Machines Corporation. IBM is one of the oldest and most enduring technology and consulting enterprises on the planet, today focused on hybrid cloud infrastructure and artificial intelligence services. At the time of recording, shares are trading at 253, sitting between a 52-week low of 220 and a high of 324. The RSI, the Relative Strength Index, a momentum gauge, reads 56.7, which is a neutral reading. The 50-day moving average at 250 is fractionally below the current price, while the 200-day moving average at 273 sits above it, a configuration that warrants attention. Let us work through the fundamentals, scene by scene, starting with a quick business overview. International Business Machines generates revenue through two primary segments: hybrid cloud solutions, technology that bridges a company's own data centers with public cloud infrastructure, and artificial intelligence consulting services delivered under its Watson and Watsonx platforms. The competitive moat here is rooted in deep enterprise relationships and extraordinarily high switching costs. IBM's StokTok score comes in at 40 out of 100, signaling caution. Valuation scores 0 out of 20. Financial health earns 14. Profitability earns 14. Growth scores just 4. And smart money registers 8 out of 20. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, International Business Machines trades at a trailing price-to-earnings multiple of 22.7 times, meaning investors are paying roughly $22.70 for every dollar of reported earnings. That is not egregious for a large-cap technology name, but context matters. The PEG ratio, which adjusts the price-to-earnings multiple for the company's growth rate, with readings above 2 generally signaling overvaluation relative to growth, sits at 2.7. That is elevated, and in our view it is the single most important valuation flag here. The EV to EBITDA, enterprise value divided by earnings before interest, taxes, depreciation and amortization, a leverage-neutral profitability multiple, is 16.67 times. The forward price-to-earnings ratio of 20.51 reflects modest earnings expansion expected ahead. Now, the GuruFocus Value, an independent intrinsic value estimate based on historical multiples and projected growth, stands at $210.93 at the time of recording, implying a negative margin of safety of approximately 20%. In plain terms, the data suggests the market is currently pricing International Business Machines at a meaningful premium to that modeled fair value. Wall Street analysts, at the time of recording, have a consensus mean price target of $299, based on 20 analyst estimates, ranging from a low of $215 to a high of $390. The consensus recommendation is buy. The next earnings report is due April 22 of 2026, with the street expecting earnings per share of approximately $1.81, with a range of $1.70 to $1.91. A near-term catalyst worth monitoring closely. On moat, in our view, IBM's deep entrenchment in regulated industries such as banking, healthcare, and government, where ripping out legacy infrastructure is prohibitively costly, provides a durable switching cost advantage. Compared to software peers that historically trade in the low to mid-20s on price to earnings, IBM's multiple is broadly in line, but the lower growth profile makes the PEG ratio the more telling metric. Market sentiment around International Business Machines, as of the creation of this video, leans neutral, with a sentiment score barely above 0. The near-term narrative is driven more by the approaching earnings date than by any fundamental development. Overall, the valuation setup warrants caution, in our opinion. Moving to financial strength, how solid is the foundation? The Piotroski F-score, a 9-point checklist covering profitability signals, leverage changes, and operating efficiency improvements, registers 6 out of 9 for International Business Machines. A score of 6 is generally considered healthy. It indicates the business is passing more financial quality tests than it is failing. The Altman Z score, a multi-factor model originally designed to estimate bankruptcy risk, reads 3.33. Any reading above 3 is classified as in the safe zone, meaning default risk based on this model appears low. Now the balance sheet deserves a more granular look. The cash-to-debt ratio is 0.22, meaning for every dollar of debt on the books, the company holds only 22 cents in cash. That is a lean liquidity cushion. Interest coverage, the ratio of operating earnings to interest expense, telling us how many times over the company can service its debt, stands at 6.46 times. That is adequate but not fortress level. The debt-to-equity ratio of 1.98 means that for every dollar of shareholder equity, nearly $2 of debt is employed. The current ratio of 0.96, current assets divided by current liabilities, is marginally below 1, which is a signal we would want to monitor. In our view, the balance sheet is functional and serviceable, but the leverage profile leaves less margin for error than we would ideally like to see. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital, which measures how effectively management deploys all capital, both debt and equity, to generate operating profit, and is arguably the single most important efficiency metric for long-term investors. International Business Machines posts a return on invested capital of 9.09%. That is positive and above the level many analysts consider the rough threshold for value creation, but it is not the kind of number that signals a compounding machine. Moving down the income statement, the gross margin, revenue, minus the direct cost of delivering the product or service, is 58%. That is a strong number, reflecting the software and services mix of the business and genuine pricing power at the top of the stack. The operating margin, which captures what remains after overhead and administrative costs, is 18.5%, a solid mid-teens to high teens reading consistent with a mature enterprise technology franchise. The net margin is 15.69%, meaning that after interest expense on that debt load and taxes, the company retains roughly 16 cents of every revenue dollar as profit. Free cash flow margin, the percentage of revenue that converts into actual cash after capital expenditures, is 16.96%. In our view, International Business Machines runs a genuinely profitable enterprise model. The profitability stack is one of the more constructive elements of the overall investment case. Onto growth, is this business expanding and at what rate? This is where the data becomes less encouraging, and where the StokTok growth score of 4 out of 20 reflects a genuine structural challenge. Revenue growth over the trailing 3 years averaged 3.7% annually. Over the trailing 5 years, that figure falls further to 2.6% per year. These are not the growth rates that typically justify premium valuation multiples. To put it plainly, IBM is a slow-growing business by the standards of the technology sector, where double-digit expansion is common among peers with comparable or lower multiples. The market is currently pricing in meaningful improvement through the lens of artificial intelligence consulting demand, but the historical growth trend tells a more measured story. Book value growth over the trailing 3 years is 12.9%, which is a meaningfully more encouraging figure. Book value per share growth at nearly 13% annually suggests that despite modest revenue expansion, management is generating and retaining economic value. Finally, the dividend yield at the time of recording is 2.65%. IBM has a long-established track record as a dividend payer, and for income-oriented investors, that yield provides a partial return cushion during periods of price softness. However, in our view, the core growth profile is the most significant constraint on the bull case, and we would want to see evidence that the artificial intelligence pivot is translating into accelerating organic revenue before upgrading this dimension. Now let us talk smart money, what institutional capital is actually doing with this name. 14 top-tier guru investors currently hold a position in International Business Machines, according to the data available at the time of recording. That is a notable number in absolute terms, and it confirms the company remains on the radar of sophisticated long-term allocators. However, The direction of those holdings tells a more cautious story. Looking at the top holders by name, Kahn Brothers Group holds a position but has been reducing, trimming by approximately 18.57%. David Katz at Matrix Asset Advisors also reduced their position by approximately 3.08%. Dodge and Cox funds similarly trimmed by approximately 1.03%. Thomas Russo of Gardner Russo & Quinn is the outlier, recorded as a buyer. So the dominant posture among named Guru holders is reduction, not accumulation. Turning to the broader institutional universe, only 20% of 13F filers, these are institutional investment managers required to disclose their equity holdings to the Securities and Exchange Commission, are classified as net buyers. A reading above 50% would be considered net bullish. 20% is well below that threshold, suggesting institutional sentiment is broadly cautious or neutral at best. Insider ownership stands at 0.33%, which is very low. Management holds a minimal economic stake alongside public shareholders. That is a yellow flag in our analytical framework. On the constructive side, insider transaction activity over the trailing 3 months shows 3 buys and 0 sells. The absence of insider selling is modestly reassuring, but the low baseline ownership level tempers the signal. In our view, the smart money picture is mixed at best. And finally, the verdict. Let us bring it all together. On valuation, the data suggests International Business Machines is trading at a premium to its modeled intrinsic value, with a PEG ratio that implies the market is pricing in growth the historical revenue trend has not yet delivered. This warrants caution, in our opinion. On financial strength, the balance sheet is functional, and the Altman Z score places the company firmly in the safe zone. But the leverage profile and lean cash position leave limited buffer, a serviceable foundation, not a fortress. On profitability, this is arguably the strongest pillar of the thesis. Gross margins above 58% and a free cash flow margin approaching 17% demonstrate a genuinely efficient enterprise model. On growth, the trailing 3- and 5-year revenue expansion rates of 3.7% and 2.6% respectively represent the most significant constraint on the investment case. The artificial intelligence narrative is compelling, but the data has not yet confirmed acceleration. On smart money, with only 20% of 13F filers net buying, named gurus broadly reducing, and insider ownership at a fraction of 1%, institutional conviction appears limited at this time. Overall, based on what we see, the setup for International Business Machines is one of a high-quality enterprise franchise trading at a valuation that already reflects optimism the fundamentals have yet to fully justify. One might argue the case for patience here, waiting for evidence that the artificial intelligence pivot converts into measurable revenue acceleration before establishing or expanding a position. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That is the deep dive on International Business Machines. Like and subscribe so we can keep providing you with no-nonsense data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.